Welcome to this video, and in this video I'm just going to do a brief introduction into momentum indicators. And for some of you this may be very elementary, for some of you not. And I'm just going to pick a basic momentum indicator, and I'm going to probably do a multiple series on this. This is just introducing on how to look at momentum indicators. So what I have here on this chart is I have the SPY. This is just a daily chart. I have candlesticks here. And what I'm going to do is I'm going to insert an indicator here, and I'm going to pick a stochastic oscillator. And that's a pretty popular momentum indicator. Basically what it does is it picks a price movement between a range, and then it kind of ranks that between 0 and 100% of the range. So the price is always going to oscillate between 0 and 100%, something like this. And so basically a lot of people like this indicator, and right now, like again, I'm running this on a 15-minute period. It's a pretty popular indicator. You can pretty much find it on any software. You know, there's all different types of indicators, momentum oscillators you can use. This is just one that I'm looking at right now. You can make this a little bit longer if you want. You can make this a 20 if you want, something like that. 20 is a good number. I think you could even go higher. I mean, if you want to go higher, it's fine. You could go 25, you know, whatever you want to do. You know, I've seen people use 40. It really doesn't matter. So a lot of times people take these oscillators, and their first response is that oscillators work great in a sideways market, but they don't work in a trending market. I'm just changing the dates here. So a lot of times people, you know, will basically say, well, you know, these oscillators work great in a sideways market, but then they don't work well when the market starts trending. And so they'll give an example. You might look at a sideways market like this, and somebody might say, you know, may look at this. Let's take a look at this region into here. They may look at that region, and they may say, well, look at the stochastic. Every time it oscillates up and down, it works really nice into here. When you know, a lot of times people interpret this as a buying area when it gets below a certain percentage, like 20, and when it goes above 80, they may say that's a sell. And so they say, well, it works really great into here. You know, you bought, you sold into here, you bought into here, you sold into here, and you know, then you bought down in, you know, into here, and then you know, you bought again into here, and it looks like it works like magic, right? I mean, it's just an amazing indicator. Until the market changes its behavior and the market starts to trend, right, like we have here. And again, this is the SPY right here. This is 2010 data. This is August. This was our August 2000, sorry, our May, June, July, August 2010 summer, which really consolidated into here. By the way, on another video, I'll show you that this followed the transits perfectly into here too. But basically, the behavior here was a stochastic type of an environment, and it behaved really nicely according to stochastic. So if you just traded this stochastic, you know, sell at the top, buy at the bottom, you did great. But what happened into here? Once we started to trend, right, the behavior changes now, right? The behavior is totally different now than it was. Look, take a look at this. So if you follow that same motto and you sold up into here, what happened? Well, the market kept going without you, and so this is where people get frustrated. With these, because you know, a lot of times, say it crossed here and you sold here and you were expecting it to come down, it just kept going up. So you know, a lot of times people will rule out oscillators, and again, I use my own oscillators that I've written, but you know, you can use any type of an oscillator. Stochastic works fine. Let me just tell you how I interpret stochastics and how you can interpret them. To help you out in any environment, and it's a nice backdrop just to put up here. And you know, you can use, maybe stochastic's not your indicator, maybe you like rate of change, or maybe you know, maybe you like MACD, or maybe whatever it is, but this is just a pretty basic one. So again, I have my stochastic here at 25. You may notice there's something here called a slowing period. Basically this is just a moving average that runs along the stochastic. So the stochastic, again, to summarize, will always be between 0 and 100, and most people interpret this as when it gets down into here, it's a buy, and sometimes if it crosses back, it's a sell, or if it crosses back here, it's a sell, or when it gets up into here. Let me just tell you how I interpret the stochastic indicator. I've seen this interpreted this way before. Basically, here's how I interpret this. I interpret this stochastic indicator not necessarily to be a buy once it comes down into here, or necessarily a sell once it gets to the top. So for example, it's not necessarily a sell just because it's up here. What I do is I tend to look at when it's crossing certain points. So for example, I tend to keep the stochastic oscillator basically if it crosses up above this 20, it's a buy, okay, until it crosses, let's use this example, it crosses up above this 20 here, it's a buy. Now I wouldn't necessarily say it's a sell just because it's up here. I would wait until it crosses back down above that 80. And it doesn't have to be 80, you could have a 90 or a 10. So for me, the buy signal is from here, okay, crosses up until it hooks back down again. Okay, so that's a big difference. So I'm not looking to sell until it crosses below that 80. Okay, so why is that important? Well, it's important because when you get into these trending environments right here, like right here, I would have sold once it crossed into here. I would have sold into here, and I would have kept it going down, and then once it crosses back up above here, I would have made this a buy signal right here. So the way that I would have done this was, into this point right here, once it crosses, I would have made that the sell. It stays into a sell even when it's down here until it hooks up. Now it's a buy. Now a lot of times, a lot of people will say, well, that stochastic got pretty high, I'm going to sell it there. But based on the way I look at stochastics, I'm going to keep long on that position all the way until it crosses back down again to here. Or maybe even into there. No, I think that was it. That right there. That was the exit there. So instead of you just selling out right away, I waited until it crossed below that 80% line before I got out. And I stayed short. Now you can argue about what you want to do in the middle here if the moving averages cross back and forth. I typically just tend to stay, I would have tended to stay short there, and then I would have jumped back in right there, right when it crossed back up again, above that 80. So there's two ways to look at this. So you're in a sell, okay, until it either crosses all the way back down here and hooks up above the 20, or unless it hooks up above the 80 again. So let me clarify that again. Sell, when you cross below the 80, you're running all the way down below the 20, hooks up again, that's a buy. The second condition for a buy is if it goes down and then it hooks up above the 80 again. So basically, if it hooks up above the 20 or above the 80, it's a buy instantaneously. And that's a completely different methodology from a lot of the traditional views of stochastics, because most people say, oh, this is overbought into here. Well, I've even seen a trading system presented by somebody that strictly is based on hooking up above the 80% line. In other words, they will only buy the stock once it crosses above that 80 and stays above the 80. And so they call that, I think, if I remember correctly, it was Jacob Bernstein who had this in one of his books, and he called it the pop, like kernels getting ready to pop like popcorn. And he called this, I think it's called the stochastic pop when it crossed above 80. That's only when he would buy. And so that runs completely contrary to what most people do. Most people say it's up here, it's ready to sell. But again, in this trending context, it makes complete sense. So there's the two conditions here for the buy. It hooks up above the 20, or it hooks up above the 80. Okay. So in this case, it hooked down above this 80, so we sold, stayed into a sell, hooked up, buy, went above the 80 again. That's another buy, confirmation there, stays above. Hooked down, sell. Now it never made it back down here to the 20. So it's in a sell, it's in a sell, it's in a sell. Pop, hit the 80 again, buy. Okay, so this is just, again, this is another way to look at the stochastics. And you can get these false numbers in here. I mean, occasionally it can cross back down. So we would have been long into here. We would have, right there would have been short, and then we would have immediately, it would have popped back up there, would have been long, and so on. And you can get whipped around a little bit into here. I mean, I think right there you would have gotten whipped a little bit, but again, you would have been back long again into here, and so on. So not a perfect oscillator, nothing is, but we know now that you should be looking at that stochastic a little bit differently. So let me just put in some of the symbols that we're looking at here. So I'll just put them in with little arrows here. So right here, right when this guy crossed down, let me move this here for you. When did we cross down? Did we actually cross down here? No, we didn't. We crossed down here. Okay, let me put my symbols back in there. All right. So, come on, symbols, come back. All right. So right there, we said, okay, it crossed down from that. That's a sell. Hopefully we can see that sell. It stayed a sell, and when it crosses below the 20, it's confirming the sell again. We wait until it crosses above the 20 again. That's a buy. When it crosses above the 80 again, we confirm that as another buy. Okay, so these are all buy points, and we're going to stay long all the way in here, and then wait till it crosses below here again. That's a sell. Stays a sell, right? Because it never gets back down here. It never gets to cross up above the 20. But now it crosses back up above that 80 there, so it's a buy again. And we got a couple of little false moves here. We got a sell here, and we got a buy here. But again, given the larger context of the move, I think these are acceptable whipsaws into here. And we got another buy into there, and then right here, we hooked down again here. I'm trying to see where that hooks. I think it was here. Where was it? It was actually here. Stayed short there, so now we crossed down. Okay, we came down to the 20. We hooked up. So got a little bit of whipsaw action into there. I think it hooked up there, so we bought there. We sold again there. We bought again there. Right there, it hooked up. But then again, we're off to the races again. It's running up again. Wait until it crosses below. Right there. And so not a bad system. And this will actually, I mean, this is a pretty simple oscillator, but it depends on how you look at it. So you shouldn't just look at an oscillator just like everyone else does. You shouldn't just say, oh, it's up here, it's a sell, it's down here, it's a buy. It really depends upon the context of what the market is doing. And this, by the way, this works too for sideways environments, right? This works fine, right? So if we have a sideways environment here, like we were getting into here, let's go back here. So we had a buy into here, we had a sell into here, and this stayed short all the way down, right? Another selling confirmation there. We stayed short the whole time. Not a bad system, right? Not a bad system. Pretty simplistic too. Pretty simplistic way to look at this thing. Buy, sell, buy, sell. So look at all these moves you would have caught just by using a simple oscillator. So I always encourage people, you can purchase trading systems, right? You can purchase these black box systems, and you can find them on, you spend thousands and thousands of dollars for these systems. And you don't really know what it is. And like, okay, the black box said to buy, and the black box said to sell, and you see these commercials on TV and these large auditoriums with people, and they're all like chanting buy, sell, buy, because the little arrow on the screen said buy. But I always like to encourage education first. For me as a teacher, as your teacher, to help you understand the market, I want you to become educated about what's going on. So I really believe that you should learn to trade as many different type of oscillators as you can, and I really mean that. I mean, you should be able to look at the market through a variety of lenses and understand what's happening, what's the behavior as far as what's happening. And if you can do that, you're going to become a better trader. And it's not, I mean, everybody's got their own niche in their system that they like to do, and and they focus on that, and they say, wow, that's my style, and that's fine. Everybody's got their style of trading. But I really encourage people to take a look and to just put a new indicator on the screen and say, okay, how can I trade with this? Put a different one on the screen. How can I trade with this? And don't always look at the indicator the same way as other people do. One of the things that I've done through the years when I've been developing trading systems is I would just sit at this computer and stare at the screen for 5 or 6 hours at a time, looking at the same indicators that everyone else looks at, but looking at it a different way. In other words, why do certain indicators work some of the time but not other times? And how can I take this indicator that everyone else looks at and apply it in a different way? So, and it's important to understand, what does everyone else see? That's important, right? Especially when we're talking about support and resistance and things like that, because we want to know what everyone else is thinking, and especially with stochastics too. If most people are interpreting this as a peak, and we know that we're not going to sell until it crosses here. That's a good thing for us, right? I mean, just look at the SPY. If you just played this simple oscillator into here, and this is the summer crash into here, you'd have done pretty well. I mean, even into here on the bounce, I mean, again, nothing is perfect, right? But not a bad thing to look at. And I think everybody can look at this indicator, and this one right here, this one was a little bit tough because it didn't quite get to 80 and it hooked back and went down. That would have been tough right there. But you can decrease the sensitivity a little bit on this. I mean, if I want to make that back to like a 23 or something, or like a 20, this still didn't get up there. 15. Nah, it's not going to get up there. Okay. I mean, sometimes you'll get situations like this where it gets tough. If I went to a 30, it almost gets up there, or 35. No, 35 doesn't. 30. Anyway, you can kind of play around with these numbers, but I mean, you'll see more or less it basically almost touched that 80, and then it collapsed back into there, and this time it did cross down below. And I'm just kind of going along here just to kind of give a fundamental basis in terms of what we're looking at. So here we go. Here, there's our first cross up. We stayed up until here. Boom. Boom. And let's just call it, we went up there, down there, and then we got this right all the way down into here. We did miss this hook up into here. You would have missed that on a gap up. But you kind of get the idea. And I'm not even going to get into counter trend moves based on this. That's another video. The basic core concept of a trader, which is juxtaposing short-term weakness against long-term strength, and that's the core of what a trader does. And you may have heard in slogans. I mean, you hear this, well, buy on the dips, and what is that saying? It's saying there's long-term strength, short-term weakness, and you're juxtaposing those two things on top of each other to get that. But there's better ways to do that than just look at dips. We're going to look at, in another video, I'm going to talk about RS or stochastics or RSI or whatever the momentum indicator is in terms of juxtaposing that weakness on top of it, so you can clearly get some entry points. So let's just say that you happen to open this indicator and you're right into here in the middle of October, and you're like, well, kind of missed the move already because the stochastics are already in the middle here. The next video I'll show you on stochastics is how to juxtapose that against this current strength into here. One more thing that you might want to do is you might want to just put, you can put some horizontal lines in here. I have 20 and 80. You might want to put one right in the middle, right at about 50% into there. And what that does to me is that tells me a reference point that, okay, it's halfway there. And it just kind of gives me something to look at. And I know that if it's charging through that point, then that's a healthy sign, charging through it either way. When I mean charging through it, I mean the stochastic is separating from its moving average into there as it's passing through that 50% line. You see how it's getting wider and wider and wider into there? That's a healthy sign. That means that the trend is accelerating into there. Same thing into here. If it's getting wider and wider and wider, that's a healthy sign into there. And it doesn't always do that around it may be kind of dilly-dallying around into here. But when we see that charge of a move and we hit that halfway, we say, okay, it's moving. The trend is really, we got a strong trend into there. So it's kind of just a confirmation point, that halfway point, for you to take a look at. So again, I encourage everyone to trade as many different types of oscillators as possible, and to just try to take a look at it from different perspectives, not just the traditional way of looking at oscillators. Because if you look at things in a traditional way, you're going to do what everyone else does, and everyone else loses money. So that's, you always got to understand that when you're trying to make money or get an advantage on the market, the first thing you need to ask yourself is, what is everyone else doing? What does everyone else see? And what everyone else sees is, you can take that into account, because sometimes it works if you're in a strong downtrend like this, right? If you see this clearly, is torrential pouring down into here as it's crossing. Everyone typically sees these points where it's crossing that 50% line, but a lot of times people won't see these. When we get into these low volatility and environments here, when I mean low volatility, let me take a standard error channel here, just something pretty simple. Look at that channel, right? This is very low volatility. So when we have a bull market or a bull run, that's what you see. You see low volatility. You see this creep like this, and that's when these stochastics get up into here, and that's where people miss out. And when we start getting this more really crazy volatility into here, that's definitely more of what we see with the top, and that's dealing with like a consolidation type of an environment, where traditionally more that stochastic is running the range back and forth. But either way you apply the stochastic, it works, and it's not a bad place to start, and it's not a bad backbone indicator to have, because you want to have a backbone indicator. From whatever you're looking at, you want to have a method to just look at something and have that as your backbone basis, and I have one of my backbone bases that I use is the polar R squared, which is an indicator that I developed from the R squared, but basically it just flips positive or negative depending on the trend. That's just kind of what I use as a backbone. But stochastics is a fine backbone too. Look at this period into here of low volatility, right? Very low volatility, and the same thing, it worked with stochastic. I mean, if you saw into there, you could have gotten right here into a buy, and you would have stayed into that all the way until, probably would have gotten on that first downtrend in there, but okay, didn't quite cross there, right there. So you would have probably eaten it into there, depending on how much loss you wanted to take. It's up to you. But if it broke out of that channel, that's probably an indicator that you want to be out of that anyway. So if I extend that right, let me make that channel a little wider, make it 2.5. Okay, so you broke that channel, right, on the open. Probably a good sign that you want to be out of that thing, right? Just saying. That's just something to look at. All right, so that concludes this video on stochastics and an introduction into stochastics and how to use stochastic oscillator as a backbone for your trading system or whatever you're looking at. And again, you can do a lot of positive damage. In other words, you can do a lot of, let's not use the word damage. You can do a lot of positive profits with a very simple indicator, as long as you follow it and you have a simple set of rules. And obviously there's tweaking going on all the time around these these indicators. But as far as like having a backbone and like a general staple that you use all the time, stochastics or any momentum oscillators can be very effective in creating profits for your account. All right, so that's all I've got for you tonight on this lesson on an introduction into stochastics. And I'm Shane Smolian. Thanks for watching, and I'll have another video on stochastics with how to play counter trends in the stochastic, and that's how you can jump in the middle to realize to get into the trend, or maybe to get out if you think it's overheated within the trend. All right, thanks for watching.